Now, yields on government securities are relatively stable this week after the volatility that marked the Monetary Policy Committee's decision to tighten monetary policy last week, and the naira is also closed slightly weaker against the dollar today at 160.7 to the US dollar. Right now, we're joined by Kizito Odunze, a bond sales trader, bond sales at Dundee Merrifield. Thank you so much, Kizito, for joining us. So I think a lot to talk about. I think the big takeaway after all the volatility last week is that we're seeing a more stable market today. Yes, the naira is slightly weaker, but in the fixed income market in particular, we're seeing relatively stable yields. I gather that today was a bit of a quiet day in the interbank market for bonds.
Wale, thanks for having me. As you said, the market was a bit quiet. We noticed slight movements. There was some price appreciation in some FGN bonds. The T-bill market was a little less volatile. The market was flat for most of the day. We had very slight movements in yields for the benchmark 91, 182, and 365-day bills. The movement was within 5 to 10 basis points, very marginal. However, for the bonds, in as much as it was also muted, the 2017 bond, which is like the 4-year term to maturity bond, moved a little bit, moved the most. It moved about 20 basis points.
Right.
But apart from that, the market was, as you said, muted.
But how stable do you think this market can stay, though? Because we do know next week we're going to see the impact of that MPC decision to to take out 50% of all public sector deposits. I think it's very important to state that that policy hasn't been effected just yet. It's something that we're going to see sometime next week. So from between now and then, your thoughts about how the market is likely to trade?
You know, when the policy was announced, we noticed some volatility as a direct result of that pronouncement. However, with the clarification as regards the exact date of commencement, the market seemed to settle down a bit. Well, that just brings to mind the possible changes that would happen come the date of commencement. You would agree with me that FX traders who have long positions in the dollar would probably need to unwind some of those positions to make more naira available in case their institutions, especially for traders in banks, are exposed to the public funds that would get some heightened level of sterilization per se. So I expect that despite the fact that the market has settled down, towards the end of the week and as we approach the D-Day, for want of a better word, we would see traders start adjusting their positions. And it's likely that that should give the naira some demand pressure because we'd expect traders to unwind, those of them who are long, to unwind some of those long positions to make the naira available to satisfy the new CBN regulation.
Right, but do you think the fears are justified? I think a lot of people are saying that rates are going to go crazy. The MPC has gone way too far this time. And of course, we do know that part of the strategy is to reduce the cost of mopping up excess liquidity, because what we find is that many of the banks that have these public sector deposits simply just place them in treasury bills, and so they're trying to reduce the cost of that mop-up process. So your thoughts about what this means for rates long term? Do you think we're going to see a major shift in terms of where rates are?
Well, long term, there is a likelihood. However, let's address the short-term issue first of all. In the short term, every bank would need to, or every institution would need to adjust to the new regime. The CBN had been mopping up, so there has been some liquidity tightening. This week, we've not heard of any OMO activity.
Right.
Now, we would expect that because the CBN has probably done something more structural and more long-term. So what I'm trying to say is that tightening is not new per se. So I don't expect that major shift, a structural shift in yields. And if you also agree with me, there are also other significant partners in this bond market. You have the foreign investors who play a significant role and who have a certain level where they are a bit satisfied to come into the market. We are not far from there. There's this general consensus in the market, or there's this talk in the market that when rates approach 14% or thereabouts, we would probably see a newer, renewed interest from the foreign from the foreign guys, especially considering that talks about tapering have taken some have been dampened.
So when
somewhat.
you say 13%, are you saying 13% for T-bills or 13% for bonds? Or 14? Oh, sorry, I thought you said 13 there because we're already at 13 for bonds,
Yeah.
clearly. So you're looking at 14%
13.6,
for bonds.
14%, we expect some demand pressure from the foreign guys. Now, that should somewhat counteract the perceived negative effect on the markets by this CRR policy. But eventually, we'll just have to watch and see how it eventually plays out.
Well, if we come back to the issue of the Naira, before the MPC, a lot of people were suggesting that we now have a new normal for the Naira at over 161. Now it's about 160.70. So it has strengthened quite a bit since just before the MPC. Your thoughts about where we could find a new normal for the Naira after this shock decision?
I think Naira would remain within the 160, 161 range for some time, at least until the D-Day. After that, we will now reappraise the fundamentals and the different pressures affecting the Naira. As for now, and in the short run, I expect the Naira not to move. When the D-Day takes place and we now notice a new tightening in the system, which will affect ability of institutions to take positions and all whatnot, we will now see. But I don't expect the Naira to take any more of a heavy bashing. Right. If anything, I expect some stability or some gradual appreciation.
All right, if we come back to the issue of the federal allocations, which of course is part of those public sector deposits that this policy is expected to target. And now in the past, we know that they've always had an impact on liquidity in the interbank market. So I think that dynamic is going to change significantly because in effect, what happens is that only half of whatever comes in every month will be available in the interbank market. Your thoughts about how this is likely to impact short-term interest rates, particularly in the interbank market?
Fundamentally, you would expect that since the supply for interbank funds have reduced dramatically, you would expect rates to hike up because there will be a lot more people chasing fewer funds. And if this policy perpetuates and continues indefinitely, you would expect that the dynamics of that market will have changed because net placers would now be a little bit wary of placing money with other banks because there is a lot more demand for their funds. There is the fact that they are being encouraged in a tacit manner to more publicly fund real the real sector. So I feel rates in the interbank markets would face some structural shifts to the higher side.